Now let's take a look at some of the other budgets that we can prepare based on all of those production budgets we had just learned about. It is important to remember the process of how these budgets are performed. First, we have to do that sales budget because that's not only going to tell us how much revenue we expect to get in, it's also going to tell us how many units we need to produce, and then all of those other production budgets that go along with that. From these 3 product cost budgets, we can then build our cost of goods sold budget, our budgeted income statement, and we can also look at our sales administrative budget as well as our cash budget. The cash budget includes the cash receipts budget and the cash payments budget. The selling and administrative expense budget stems from that original sales budget that we prepared. But this is going to tell us how much expenses we expect to have based on that sales budget. All of these numbers are going to be given to you. You just have to put them together and know that it stems from that sales budget. The cost of goods sold budget is prepared by taking the direct materials budget, the direct labor budget, and the factory overhead budget and combining those to look at how much we are going to expect to sell and how much these sales are going to cost us. We also have to estimate that desired ending inventory from the direct materials, work in process, and finished goods and integrate those into that cost of goods sold budget. Now that we've done our sales budget, our cost of goods sold budget, and our selling administrative budget, we can prepare our budgeted income statement. This will tell us how much income we expect to have based on those budgeted sales. The first step in the cash budget is to estimate our cash receipts. Our cash receipts are coming from our sales budget. We have to take into consideration both our cash sales and the collections we make from our accounts receivable. Our collections from accounts receivable are not immediate cash. We have to look at how the company expects to receive cash from these sales. Typically, they'll tell you that what percentage they expect to receive each month. In this example here, they expect to receive 60% in the month of the sale and 40% the following month. Therefore, if we look at February, you know that 60% of February sales are going to be collected during that current month. Plus, then they get 40% of the previous month's sales. So I would take 40% of January, show that that's being collected during February, because our goal in the cash receipts is to show how much cash is coming in from each of those sales. The second step in our cash budget is to estimate our cash payments. Cash payments must be estimated for manufacturing costs, selling expenses, administrative expenses. We also have to look at capital expenditures, dividends, interest payments, or long-term debt payments. But again, we're only looking at actual cash that's being paid during that month. So when we try to estimate our cash payments for manufacturing costs, we need to adjust for any of those non-cash expenses. A non-cash expense is something like depreciation, which would be included in our manufacturing costs, but does not affect our cash. Now, our typical cash payments are done just the way we did cash receipts. We won't always pay the full amount of our expense in the month that is incurred. In this example here, we pay 75% in the month that it's incurred and 25% the following month. So let's take a look at February again. First, we take our budgeted manufacturing costs for February. We adjust for that depreciation since that is a non-cash expense. And then during this month, we will include 75% of those manufacturing costs for February. We also would include 25% of those costs from January, since those will be paid during February. There's nothing in this example that shows that, but we also have to look and see if there's any dividends being paid that month, any interest or capital expenditures, and things of that nature that we need to add to our cash payments for each month. After we've completed the cash receipts schedule and the cash payment schedule, we can finally build our cash budget. In our cash budget, we take our estimated cash receipts, we subtract our cash payments, and this will show us our increase or decrease in cash for the period. Then we would add our beginning balance from the month for the cash. This will show us how much cash we should have at the end of the month. We always require a minimum cash balance, which they'll tell you what it is. We need to make sure we are above this minimum cash balance. This will show us, if we subtract our minimum cash balance, it will show us our excess or deficiency in cash for the period. And finally, we can look at the capital expenditures budget and our budgeted balance sheet. The capital expenditures budget is just looking at all of those capital expenditures we expect to have over the year so we can budget accurately for them. The budgeted balance sheet is prepared based on the operating and financial budgets of that master budget that we can prepare. It's dated as of the budgeted period and is similar to a normal balance sheet, but just estimated amounts are used.